The Affordable Care Act, commonly known as the ACA, introduced a range of tax provisions designed to expand health insurance coverage and improve affordability. These provisions include the individual mandate, premium tax credits, and employer-shared responsibility requirements. Recent legislative changes have altered some aspects of the ACA, such as reducing the penalty for not having health insurance to zero at the federal level. For taxpayers, this means adjustments in how they claim premium tax credits and report health coverage on their tax returns. Employers, particularly those with 50 or more full-time employees, must continue to comply with reporting requirements and may face penalties for not offering adequate coverage. Overall, these changes aim to balance the goals of broadening coverage while addressing concerns about cost and compliance. The Tax Cuts and Jobs Act, commonly known as the TCJA, was a significant piece of tax legislation passed in late 2017. One of its notable provisions affected the Affordable Care Act's individual mandate, which required most Americans to have health insurance or pay a penalty. Starting in 2019, the TCJA reduced this penalty to $0. This means that while the mandate technically still exists in law, there is no longer a financial penalty for not having health insurance at the federal level. The change aimed to give individuals more flexibility in their health coverage choices. However, some states have enacted their own mandates with penalties, so the impact may vary depending on where you live. Several key provisions of the Affordable Care Act remain unchanged and continue to impact employers and insurers. The Patient-Centered Outcomes Research Institute, or PCRI, fees are still required, helping to fund research that informs healthcare decisions. The health insurance provider's fee also remains in effect, applying to certain insurers. Employers must continue to comply with shared responsibility rules, which mandate that applicable large employers offer affordable health coverage to full-time employees. Additionally, reporting requirements associated with these rules persist, ensuring transparency and accountability in health coverage offerings. These ongoing provisions play a significant role in maintaining the structure and goals of the ACA. The premium tax credit is a benefit designed to help eligible individuals and families afford health insurance purchased through the health insurance marketplace. To qualify, your household income must fall within a specific range, and you cannot be eligible for other qualifying coverage, such as Medicaid or employer-sponsored insurance. Some people choose to receive advance payments of the credit, which are sent directly to their insurance provider to lower monthly premiums. If you received advance payments, you are required to file Form 8962 with your federal tax return to reconcile the amount received with the actual credit you qualify for. Form 1095A, provided by the marketplace, contains essential information needed to complete Form 8962. It is important to keep this form and use it accurately to avoid delays in processing your tax return or potential repayment of excess credits. On January 2020, two significant taxes related to healthcare were officially repealed. The medical device excise tax, which imposed a 2.3% levy on the sale of certain medical devices, was eliminated. This tax had been a point of contention within the medical technology industry, as it was believed to increase costs and potentially stifle innovation. Additionally, the so-called Cadillac tax, aimed at high-cost employer-sponsored health insurance plans, was also repealed. The Cadillac tax was originally designed to curb excessive healthcare spending by taxing more generous health benefits. With both repeals, manufacturers and employers saw relief from anticipated financial burdens, marking a notable shift in healthcare policy. Health coverage provided to employees' children under the age of 27 is generally tax-free. This benefit applies even if the child is not a dependent for tax purposes. The tax-free status extends to various types of plans, including workplace and retiree health plans, as well as cafeteria plans that allow employees to pay premiums with pre-tax dollars. Self-employed individuals can also take advantage of this provision when deducting health insurance premiums for their children under 27. This rule helps ensure that both employers and employees can offer or receive health coverage for young adult children without facing additional tax burdens. Understanding these guidelines can help families and businesses make informed decisions about health benefits. Section 501(c)(29 of the Internal Revenue Code grants tax-exempt status to certain non-profit health insurance issuers that participate in the Consumer-Operated and Oriented Plan, or COOP, program established by the Affordable Care Act. These organizations are designed to provide affordable, member-driven health insurance options. To qualify, a co-op must be organized as a non-profit, operate primarily to offer qualified health plans, and meet specific governance and membership requirements. Tax-exempt status means these organizations are generally exempt from federal income tax on income related to their exempt purposes. However, they must comply with strict operational guidelines to maintain this status. The goal is to encourage competition and consumer choice in the health insurance marketplace, while ensuring that profits are reinvested to benefit members. Retiree drug subsidies are payments provided to employers to help offset the cost of prescription drug coverage for retired employees. Historically, these subsidy payments were not considered taxable income, and employers could also deduct the full cost of the prescription drug expenses, effectively receiving a double benefit. However, statutory amendments enacted after 2012 changed this landscape. Now, employers must reduce their deductible expenses by the amount of the subsidy received, eliminating the previous tax advantage. These changes were introduced to align tax policy with broader healthcare reforms and to ensure a more equitable tax treatment of employer-sponsored retiree drug benefits. Navigating the tax provisions of the Affordable Care Act can be made easier with a variety of online resources. The IRS website offers comprehensive information tailored for individuals, employers, and organizations, covering topics such as tax credits, reporting requirements, and exemptions. In addition to the IRS, other federal agencies provide helpful materials that clarify specific aspects of the law. These resources include guides, frequently asked questions, and interactive tools designed to assist users in understanding their responsibilities and benefits under the ACA. By exploring these official websites, users can access up-to-date information and find answers to common questions about compliance and eligibility.